Ever walk by some companies and like be kind of shocked by how fancy their offices are?
Oh, totally. You mean like those ones that look like they're straight out of a magazine, all glass and steel?
Exactly. And you can't help but wonder, is all that really necessary? Especially if the company isn't doing so hot a few years down the line. Makes you think.
It does make you wonder about their priorities, right? And that actually brings us to today's deep dive. We're talking about how companies account for their big ticket items.
Mhm.
The buildings, the equipment, all the stuff that lasts for more than a year.
So we're talking about IAS 16, basically. But it's not just about like obsessing over spreadsheets, right? There's got to be more to it than that.
You're right, it's not just about crunching numbers. IAS 16 is the accounting standard that lays down the rules for property, plant, and equipment. It ensures those assets are accurately reflected on a company's books. Think of it this way. A brand new factory and one that's been around for decades are going to tell very different stories. Yeah.
Right, like a brand new one versus a used one are going to be valued totally differently. So IAS 16, it's about making sure investors like you and me are getting the real deal, right? Not some inflated picture of a company's worth.
Exactly. It's about transparency and giving a realistic view of a company's financial health.
Okay, so let's say a company goes out and buys a new piece of equipment. Is it as simple as just recording the purchase price, or is there more to it?
You've hit on an important point. It's not just the sticker price that matters. It's about capturing the full cost of getting that asset up and running. Let's say they're buying a new machine for their factory. You've got the initial price, of course, but then there's things like shipping costs, installation, maybe even training for employees to use it.
Wow, I never really thought about all of that. So it's like all those extra expenses get added to the value of the asset itself, not just treated as, regular business costs.
Exactly. And that's where things can get a little tricky because then you have to decide what gets treated as a regular expense, like a repair, and what gets capitalized, meaning it's added to the asset's value on the balance sheet.
Okay, I could see how that would require some judgment calls. So repairing a broken window in that factory, that's probably a regular expense, right? But what about if they decide to, say, upgrade the electrical system to handle a brand new, more powerful machine? That sounds more like a capital expenditure, am I right?
You're absolutely on the right track. A simple repair is just maintaining the asset at its current level, but upgrading the electrical system, that's enhancing the factory's capabilities, adding value over the long term, so it would be capitalized.
It's amazing how these subtle distinctions can have a real impact on how a company's financials are perceived. No wonder investors pay attention to this stuff.
It's all connected. You see, a larger asset value can sometimes lead to higher depreciation, and that directly impacts the profits a company reports.
Speaking of depreciation, that's a whole other can of worms, right? It's not just about things getting old and rusty.
You got it. Depreciation reflects how that asset's value is being used up over time, like that machine we talked about. It might last for 10 years, but each year it churns away, its value decreases as it gets closer to the end of its useful life.
So how do you even start to calculate something like that? It feels kind of subjective.
Well, IAS 16 allows for two main methods, straight line and reducing balance. Straight line is pretty straightforward. You spread the cost evenly over the asset's useful life. But then there's the reducing balance method, which is a bit more,
Complicated.
well, I was going to say nuanced. It front loads the depreciation, recognizing that some assets lose value more rapidly in their early years.
So depending on which method a company chooses, they could be painting different pictures of their financial health, even if the underlying business is the same, right?
Exactly. And this is where things get even more interesting. Because sometimes assets don't lose value, they gain it.
Gaining value. You mean like if a company buys a building and then the real estate market goes through the roof?
Exactly. Or think about a piece of land. It might have cost a certain amount a few years ago, but with inflation and everything, it could be worth significantly more today.
So how does that work in the books? Do they get to just like increase the value of the asset on their balance sheet just because they think it's worth more?
It's not quite that simple. IAS 16 does allow for revaluations, but it's not just a free-for-all.
So there are rules, obviously.
Oh, absolutely. They can't just pick a number out of thin air. They need to base it on fair value, which has to be determined by a qualified appraiser, and there are specific guidelines on how often they can revalue.
Okay, so it's not just like wishful thinking, but let's say a company does revalue an asset upwards. What happens then? How does that actually affect their financial statements?
Well, They would adjust the carrying amount of the asset on the balance sheet to reflect the new fair value. And the difference between the old carrying amount and the new one, that gets recorded as a revaluation
A
surplus.
surplus. So it's like a gain, but not
You
exactly.
got it. It's a gain, but it's treated a bit differently than, say, a profit from selling goods or services. It's typically recorded directly in equity, not on the income statement.
Okay, that makes sense. But I can see how this could get confusing for investors trying to compare different companies, right? Like one company might be using historical costs for its assets, while another one is using fair value. Talk about apples and oranges.
You're absolutely right. That's why it's so important to pay close attention to the accounting policies that companies disclose in their financial statements. Knowing how they value their assets is crucial to understanding their true financial position and performance.
It's like you need a secret decoder ring just to make sense of it all sometimes. Okay, so we've talked about acquiring assets, using them, depreciating them, and even revaluing them. What happens when a company decides to get rid of an asset?
Disposals. That's where things can get really interesting. It's not as simple as just taking the asset off the books.
There's got to be more to it than that.
There is. They have to account for any profit or loss they make on the disposal.
So like if they sell a machine for less than they bought it for, that's an automatic loss, right?
Not necessarily. Remember depreciation. We've been talking about how the value of an asset decreases over time. So by the time they sell it, they might have already depreciated a good chunk of its value.
So they might have already accounted for some of that loss over time.
Exactly. And if they sell it for more than its carrying amount, the remaining value after depreciation, then they've actually made a profit on the disposal.
Wow, so even selling off old equipment can have a real impact on a company's bottom line. Who knew?
It all ties back to the bigger picture of how companies manage their assets throughout their life cycle. It's about making smart investments, maximizing the use of those assets, and ultimately knowing when it's time to let go.
And this is where IAS 16 comes in, providing the framework for companies to report all of this in a transparent and consistent way.
Precisely. It's about painting a clear picture of a company's financial health for investors and stakeholders.
Makes you think about all the moving parts, right?
Yeah.
And we've been focusing on those big physical things, factories, machines, that kind of stuff. But what about the stuff you can't really touch?
Ah, you're talking about the intangible assets.
Exactly. Software, patents, intellectual property in general, that's a huge part of a company's value these days, right?
Absolutely. And it's one of the biggest challenges for accounting standards like IAS 16. How do you put a price tag on something like brand recognition or a groundbreaking algorithm?
Right. It's not like you can just go out and buy those things off the shelf. There's no receipt.
Exactly. And their value can fluctuate wildly depending on market trends, consumer sentiment, even just like the general buzz around a particular technology.
Talk about a headache for accountants.
Yeah.
So how does IAS 16 even begin to grapple with these intangible assets?
That's a bit of a mixed bag, to be honest. IAS 16 does provide some guidance, but it's definitely an area where there's room for more clarity and evolution.
So are we talking about a potential update to IAS 16 sometime soon?
It's definitely on the radar of accounting standard setters. They're well aware that the current framework needs to adapt to the realities of the digital age.
Makes sense. You can't just shoehorn a 21st century economy into a 20th century accounting system, right?
Exactly. Things like intellectual property and brand equity are just too important to be left out of the equation.
It's like trying to understand a company's financials by looking at a map without any roads or landmarks on it.
That's a great analogy. It just doesn't give you the full picture.
So for investors and anyone else trying to make sense of all this, what's the key takeaway here?
I'd say it's about being aware of the limitations of traditional accounting standards when it comes to intangible assets. Don't just rely on the balance sheet to tell you the whole story.
Do your own digging, read between the lines, that kind of thing.
Exactly. Look beyond the numbers at the company's overall strategy, their investments in research and development, their brand building efforts. Those factors can give you valuable insights into the true value of their intangible assets.
Just like we talked about earlier, financial statements are just one piece of the puzzle.
Precisely. It's about understanding the context, the bigger picture, and not being afraid to ask tough questions.
Well said. That wraps up another deep dive into the fascinating world of accounting. We've journeyed through property, plant, and equipment, tackled depreciation and revaluations, and even ventured into the uncharted territory of intangible assets.
We've covered a lot of ground today.
We sure have.
Mm.
But the key takeaway, as always, is that understanding these concepts empowers you, our listeners. It allows you to make more informed decisions whether you're an investor, an entrepreneur, or just someone who wants to better understand the language of business.
And who knows, maybe we've even inspired a few future accountants along the way.
We can only hope. Until next time, keep those financial statements in check, and remember, knowledge